Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. Rob, how you doing?
I'm doing great, Gary. Happy Monday. Excited for another issue of the Five Things. But yeah, doing really well. Actually, just got back from Lake Tahoe
All
over
right.
the weekend, which was a great little trip. Great weather. Kind of beat the 4th of July crowd. It was starting to get a little busy when we got out of there. And then last night, I actually went to a Jewish wedding, my first Jewish wedding, which was a really, really cool experience. Had a great time, actually. So that
All
was fun.
right. That's
Yeah.
that's great to hear. I'm glad
Yeah.
you enjoyed it.
Yeah, so let's get into it.
All right.
This week's episode called the Let Them Eat Cake issue. And I'm hoping we've got some cool graphics that I know we're recording now. I'm sure we're gonna have those flashing up on the screen
Oh
that
yeah.
made me laugh, and maybe you can give them some color. But we're talking Janet Yellen, memes herself. We're circling back on some auth ID information, talking Arthur Burns in Canada and what that means, the yen. I found more and more people, it seems, traveling to Japan over the last couple of weeks.
Oh yeah.
I've had two such instances of individuals going to Japan. Said great time for obvious reasons that we'll continue to talk about. Jobs data, PCE. Let's jump right into it. You ready to go, Gary?
Let's go. Here we go.
Thing number one, Gary, let them eat cake. I'll let you fill in the color.
All right. So back a couple few hundred years ago, uh, King Louis's wife, the Queen Marie Antoinette, was asked about the starving people of Paris. And there's a question of whether this story is true, whether it actually happened or not. But the rumor goes that somebody said they don't have bread, and she responded, "Let them eat cake." Now, we don't really know if that happened. There are some who say she didn't really do that, but that line has become the emblem of aristocratic indifference to the suffering of the commoners. If you don't have bread, then eat cake, right? Isn't that what we all do? But people were starving at the time, and our friends at Unicus Research, Lex Ganapathy, coined an incredible phrase last year. She once described Treasury Secretary Janet Yellen as the Marie Antoinette of our inflation. Yellen, as chairperson of the Federal Reserve, after she was once came out and said her biggest regret was not creating more inflation. So for everyone listening to this, let me ask you, was a lack of inflation something that caused distress in your life? Were you upset before a couple of years ago when prices were not going up constantly? Now that we have more inflation, is your life any better? And if the answer to any of this is you're an idiot, what are you talking about? Now you understand why we're so negative on Janet Yellen all the time. This is a person who came out in public and said, I wish I had created more inflation. Great. So now you're Marie Antoinette. Again, credit to Unicus Research for that one. So, on camera last week, Secretary Yellen was asked about grocery prices. Again, this has been a constant theme here at Deep Knowledge Investing. The Bureau of Labor Statistics keeps telling us that food prices are only up 1 or 2%. I don't know anyone who believes that. And when asked about grocery prices, Treasury Secretary Yellen was very dismissive and basically, I'm going to paraphrase, but basically said that she was detached and said, yeah, I don't think prices are up that much. Again, I'm paraphrasing, but her remarks really seem to ignore the daily struggles of families facing inflated grocery bills. There is no question that when we all go to the grocery store, we're all feeling sticker shock. Prices are up, and those price increases keep compounding. I have heard rumors. I don't know if this is true or not, but I believe Secretary Yellen has an 8-figure net worth. So if you're worth $20 million or so, yeah, feel free to fact check me on that. I don't know the real number. I can see how $100 or $200 increase in your weekly or monthly grocery bill might not really be a big deal, right? If you're worth tens of millions of dollars, you might not notice. But the rest of the country is not in that position. And for most of the country, having a $50 or $100 increase in your weekly grocery bill is overwhelming. Her insensitivity to what people are experiencing is just appalling.
Yeah, the actual quote, Gary, to give that for you, I think largely it reflects cost increases, including labor cost increases that grocery firms have experienced, although there may be some increases in margins. That's what Yellen had to say.
Yeah.
You mentioned in the takeaways kind of what you're talking about, 8 figures, not being able to correlate or understand that, or maybe even notice, right? But at the same time, she's been in DC for how long? Can't think that she thought this was a good idea or something good to say. So what does that kind of tell us about where her head is even at?
So Rob, you have zeroed in on what to me is the biggest surprise. It doesn't surprise me that somebody who lives in Washington, D.C., who has an 8-figure net worth and has been at the upper levels of power, of governmental power, of finance power, might be divorced from the experiences of a common person struggling to pay their grocery bill. That part I understand. And I'm not condoning it. I'm just saying I can understand how that would happen. The part that shocks me is that anybody who's been a multi-decade Washington, D.C. operator would actually think it was a good idea to, on camera in front of other people, belittle the increases in grocery prices and and say, you had the exact quotation, Rob. Why anybody who has spent decades in Washington would think it was a good idea to say this stuff out loud, that's the part that's beyond me. And usually when things happen that I think are crazy or stupid or ridiculous, I usually have a sense of why. And there's some sort of information asymmetry or misunderstanding or just a disagreement. But I usually understand the other point of view. This is one of those things where I'm not shocked she thinks it. I'm absolutely shocked that she thought it was a good idea to say that out loud in front of a camera.
And make sure to check out written version. I think we might pop it up on a screen, but we've got a great,
Yeah.
I don't know, maybe GPT rendering of Janet Yellen as Marie Antoinette or alongside of one of
With
her.
her, yeah. We're round of applause here to new DKI intern Alex. He did use Chat GPT and put together a hilarious graphic. I know Andrew's going to flash it up on the screen, but it's Yellen and Marie Antoinette in the middle of a grocery store holding a cake. Super creative.
With $500 sticker prices.
Yeah, right. Bacon is $3,000. It
That's fun.
really, it was great work by Alex on this. Round of applause for the DKI
Put it,
interns. Every week, these guys are just huge
yeah.
contributors. And I know I say this a lot, but for everybody who complains about the work ethic and the sense of entitlement of our young people today, spend a day with the DKI interns and you will feel better about young people. These guys are terrific.
No doubt. Put it in the Louvre. That's what I would say.
There you go.
Thing number two, moving back to Auth ID. Ticker is AUID. Auth ID completes secondary offering situation de-risking rapidly. Thing number two.
Yeah, this was huge news. So, everybody knows I initiated coverage on Auth ID a couple of months ago with the stock at $7.50. It closed at $10 today. That's a really good return in a couple of months. And a big part of it is, the company, one of the things I wrote about when I did the original report was I wrote a lengthy risk section, and it's a public venture capital company. There was risk there. And the company was open about the fact that they were going to run out of money in October or November. And that's a problem for two reasons. One is if you're a shareholder, the possibility that the company could go bankrupt, that's a huge problem. But beyond that, it's also a problem when you go to pitch to customers. Imagine you go to a customer and you say, hey, we want to be your security solution. And they take a look at your balance sheet and your cash flow statement. And they say, aren't you guys going to run out of money in 4 months? And they say, yeah. And how do you sell? How do you say we'll be there for you for years as your security or biometric security solution if you're about to run out of money? And, one of the things that DKI has done, I have been out publicly saying that we had a high degree of confidence that the company would be able to complete their secondary offering. They were looking to do $8 million. They were hugely oversubscribed. Indications were 14 million. I fully believe that had the team at Madison Global decided to spend a day making another few phone calls, they could have easily run it up to 20 million. But they had $14 million of interest for an $8 million offering. The offering was priced at a slight discount for public shareholders, but a premium for insiders. The close the night before was 801. These things always get priced at a little bit of a discount for the public shareholders. They got in at 750. Actually, I should say for full disclosure, I participated in the offering. Insiders, I believe the price was 8.16, so they paid a slight premium to the last trade on this. But now authID has somewhere between 15 and $16 million of cash. They are good for somewhere in the neighborhood of the next 12 to 18 months. The company is close to being self-financing. If not, the only reason they wouldn't be self-financing is if the growth rate is such that they need to do another secondary offering next year so that they can grow faster. Should that happen, that's a round of applause, right? I mean, that's a good problem to have when you need money because you're growing so quickly. So, not only does this offering eliminate significant downside in the stock, it de-risks the situation in a huge way. I believe it's encouraging to potential customers who no longer need to consider the possibility that this company is going to run out of money. Huge win all the way around. Round of applause for the management team at authID and for the guys at Madison Global who, brought home a massively oversubscribed offering with a lot of really smart investors and some new institutional investors and hedge fund investors. The shareholder base is being diversified a little bit, and this couldn't have gone any better.
Gary, you mentioned in your write-up kind of 3 catalysts or things they needed to do to succeed. The first being just financial reporting, cleaning up that, getting good data and information out to investors. Ed Soletto, I know, has come in as CFO, shored that up. Just talked about, obviously, this secondary round and offering in terms of getting that cash into the bank account for them to use. Third catalyst we talk about is sales outlook. What's the focus now for authID?
Those are the key issues, Rob. So when I wrote the original report, again, the stock was 750. This is a couple of months ago, and I made sure to include, like I said, a very long risk section. And I basically in that report said there's a 1 in 3 shot that this company has a catastrophic outcome because there were problems with financial reporting. We hadn't seen sales, and they were going to run out of money. So, and by the way, some people didn't like that I wrote that, but the company almost went bankrupt last year. They almost got delisted. There was risk here, and I acknowledged it. But here's where we are. Ed did a fantastic job cleaning up the company's financial reporting. I am 100% on board. They are providing very clear, discrete disclosure in a format that I think makes things really clear. And that was necessary. He did a beautiful job on that. This offering, led by Madison Global, puts the company in a position where they will not need cash for at least 12 to 18 months, possibly ever. But again, if the growth is faster than anybody thinks and they need more cash, great, that's terrific. At this point, success for the company is being handed over to CEO Ron DeGuro. He came in a year ago and has built up a fantastic sales force and is currently in the process of flying all over the country, meeting with potential clients, potential customers. Ron he was the chief revenue officer at Socure and helped take them from a few $1 million in sales to over $100 million in sales by signing 1,200 contracts. He is one of the best in the business at this. There is no one I would rather have in this position. And so we'll see, and he's always said that sales this year will be second half weighted. So he's right on schedule. And at this point, I think the story has been de-risked. When I wrote the report, like I said, a couple months ago, I thought there was a 1 in 3 probability of a really bad outcome here. I think at this point that's been cut to single digits. And so the upside is still, 10 to 15x that $7, $8 stock price when I first looked at it. But the probability of a really bad outcome here, in my opinion, has gone from somewhere in the 30-35% range to somewhere in the single digits. And so originally, I really liked authID as a risk reward play. Now I like it a lot more as a risk reward play for, people who are subscribers of Deep Knowledge Investing. They have been advised in the past at prices much lower than this that I was increasing my position and that, as a firm, we were taking a much larger position. And I think, as of today, they're pretty happy about it.
Awesome. Strong words coming from you there, Gary, and good things on the horizon, it appears, for authID. We'll obviously keep everybody in tune with developments and be sure to check out that initial research report on the website. Thing number 3, we're moving north of the border. Canada makes the Aurthur Burns mistake. Tell us more about that, Gary.
All right. So everyone, spoiler warning, we're going to talk about economic history. I know you're really excited. Please don't turn off this channel yet. But here's your economic history. I know everyone's so excited, like they tune in because who doesn't want to know more economic history?
Yeah.
So if we go back, the horrible inflation that the United States had in the late 1970s, where we had gas lines and just all kinds of horrible problems, that actually started in the 1960s. And the chairman of the Federal Reserve at the time was Aurthur Burns. And we had bad inflation, and Burns followed the usual prescription, which is to raise interest rates. And it started to be effective. And the inflation rate, the CPI, started to come down. And now I don't know if this part of the story is true, but the legend goes that President Lyndon Johnson at the time was at his ranch in Texas, called Burns to come see him. President Johnson was a large man. He was an imposing physical figure. And the story goes that he picked up Burns, slammed him against a wall, and told him, "You will lower interest rates," and it basically intimidated the Fed chairman into lowering rates. Now, the problem with that is Burns let off too soon, lowered interest rates, and inflation came roaring back. And what ended up happening was Burns was replaced later in the 1970s by Paul Volcker as chairman of the Fed. And what Volcker had to do to get inflation under control was he ran the Fed funds rate up around to somewhere around the 20% mark. Okay, so people right now are complaining that the midpoint of the Fed funds range today is 5.3%. Try to imagine it being 4 times that level. Try to imagine getting, right now, people are upset about 7 or 8% mortgage rates. Try to imagine 25% mortgage rates. Right. And this is what people were living with in the late 70s and early 80s. It was a huge problem. And a lot of it was caused by the fact that Aurthur Burns let up early. Now, what happened in Canada was they're having the same issues that governments all over the world are. Central banks are being begged by their financial communities, just like here in the United States. They're saying, please lower rates, lower rates, lower rates, because it blows up asset bubbles. And if you own a lot of stocks, it's a great way to make a lot of money. And they don't care that they're going to ruin the economy with that. They just want to make a lot of money today. And I'm not against people making money, but there are more sane ways to do it. So the Bank of Canada, they blinked. And they blinked really early, and they reduced their policy rate, their version of the Fed funds rate, to 4.75%. I think they lowered 25 basis points. So I think they were at 5%. They went down to 4.75%.
That's correct.
Yeah. And so here's what happened. The May inflation data the April inflation data in Canada had been 2.7%. People were expecting 2.6%. They got 2.9. Right. And so as soon as they tried to lower rates just by the smallest amount that they could, inflation comes roaring back. And basically what that tells me is that no one in Canada knows anything about economic history. If you are in the Canadian government and you are watching this, congratulations, you have now learned some economic history. Reach out at Deep Knowledge Investing. We can help you here because you guys need it. I don't know what to tell you. And I grew up just outside of Detroit. I grew up in Michigan. Literally, we would go to Windsor for dinner or for drinks. Toronto was a day trip. Canada was a wonderful neighbor. I wish nothing but health and happiness for our Canadian friends, but this was not a good decision.
Definitely, you would think, Gary, this has got to be getting Powell's attention. Clearly, Canada missed, and as you pointed out, hasn't been reading the weekly 5 things.
Yeah.
How do they miss this badly? And then how much attention does Powell look at this in terms of keeping that higher for longer mantra?
So, Rob, part of the issue is most people in government are financially illiterate. It's not what gets them elected. In general, the people who know a lot about finance they don't end up in politics. In fact, it's sort of a detriment, right? One of the ways you get elected is by promising people things that are infeasible, impossible, right? You promise, yeah, we're going to buy you this, we're going to get you that, we're going to increase spending on this program. You like this, we'll get you that, free this. Right. And that you get elected by promising things that you couldn't possibly pay for. Anybody who has a financially minded brain is unlikely to be elected. So, my guess is there are very few people in Canada who know US financial history from 40 and 50 years ago, but they should if they're running the Bank of Canada. Or, maybe they were just pressured and they went along with it. Here in the US, I guarantee you, Powell knows this story. He knows it inside and out. And one of the reasons why, for the last 2 years, as people have been screaming for lower rates at DKI, we've said, absolutely not. It's not going to happen. Powell means it when he says higher for longer, is because I know he knows this story. And my belief is that Powell will survive as a person with his reputation intact if the US enters a recession, something I think is very unlikely this year, given the massive amounts of stimulus spending we're seeing out of Congress. What Powell won't survive is being, for his reputation, is being the next Aurthur Burns. I think he's worried about lowering rates too soon, having inflation come roaring back, and then he gets replaced and goes down in history as the second coming of Burns. I don't think he wants that to happen. And so Canada, the Bank of Canada should have known this story, but I guarantee you Jerome Powell does.
If you are new to this show, higher for longer. If you've been around for a while and heard us, higher for longer as well. Thing number 4, down goes the yen, exclamation mark. I got to add that in there.
Yeah.
Down goes the yen. Another exclamation point for emphasis, Gary. Thing number 4.
Yeah. So for our older sports fans, that is a reference to Howard Cosell's epic call when Muhammad Ali knocked down George Frazier. And as he was yelling, "Down goes Frazier." I don't want to imitate Cosell. You can't do that, but that's what he was yelling. It's a very famous sports call. Anyway, we've talked about the Bank of Japan before. The issue that they have is because Japan has an insanely high debt to GDP ratio of over 260%, they have to keep their interest rate incredibly low. Their reference rate, their version of the Fed funds rate, is just barely above zero. It's basically 0.05%, less than what you were getting in your checking account 15 minutes ago. And they had a negative, again, their version of the Fed funds rate for 9 years. And so what's happened is, here in the US, you can make more than 4% in the 10-year. The Japanese 10-year, has been trading under 1% for years. And so people were putting on the carry trade. And what that means is they were selling yen, and that costs you, less than 1%. And they were buying US Treasuries and making 4% and capturing the spread. And as long as the relationship between the yen and the dollar doesn't move too much, it's a risk-free trade, except that relationship can move. Now, what the Bank of Japan has done, they've made a mistake. They keep trying to intervene in the currency markets. And, great chart here by Andrew, showing that in 2021, the Bank of Japan intervened with with $62 billion. That basically what they did was they sold foreign exchange reserves like treasuries and use that to buy the yen. And so, supply and demand, right? Sell the thing that's expensive, buy the thing that's cheap, the yen, and that should work, right? And then they did the same thing again earlier this year, another $62 billion of currency intervention. The problem is it doesn't address the underlying factor here, which is the massive spread in interest rates. And so they've done this twice, and in each time they got an effect that lasted for somewhere between 1 and 2 days. And the yen immediately, once the Bank of Japan got out of the market, stopped manipulating the market, the yen immediately started to slide. And we hit I believe it's a 38-year low earlier today. So just to give you guys a sense, the yen was at either 102, 103 to the dollar in 2021. Today, it was 161.5. That is a loss of almost 60% in a few years. Typically in the foreign currency market, a move of 2 or 3% in a year is considered a big move. This is enormous. The Bank of Japan is trapped, and the policy prescriptions that they're following is not working. And, just a couple of months ago, they hit 150, and people thought the Bank of Japan would defend 150. They tried. They were unable to do so. We're now on the wrong side of 160 for Japan. It is a huge problem for them.
Yeah, definitely seems like they are stuck, Gary, in between a rock and a hard place. You call out modern monetary theory, MMT. I have a good friend that I'll be sending this clip to, but I'm curious, what warning do you have for those readers or individuals that might support MMT?
Yeah, Rob, that's the right question, because people could legitimately say, "Hey, what are you doing picking on Japan? You guys in the US have your own problems." And you know what? That is 100% true. And one of the things I always make a point of doing when we talk about this is saying, "I'm not picking on Japan. They're the warning. We have the same problems here in the US." And so what they did in Japan was they kept interest rates phenomenally low for far too long, and they spent and spent and spent. And when your interest rates are negative or zero, your cost of borrowing is negative or zero. And it allowed them to spend on things that they couldn't afford. And so MMT, modern monetary theory, is basically this idea that the government can print and spend unlimited amounts of money, and debt doesn't matter and deficits don't matter because you can just print more currency, more fiat, more dollars or more yen to pay the bills. So what's the big deal? Well, watch Japan, because this is the big deal. Right now, their currency is sliding. And, remember, Japan has to import energy, and energy is typically priced in dollars. So I want everybody to imagine, if you think this isn't a problem, right? Imagine going to go fill up your car and the price is 60% higher, right? Imagine $5 gas going to $8 and how crazy people would be. Or better yet, heating your home, right? Look at your heating bill from last winter and now imagine that 60% higher. This is the problem that Japan is going through. And it was created largely by them following the kinds of MMT, modern monetary theory policies, that are creating the exact same problems here in the US. And so my warning, which nobody in Washington is going to pay attention to, is that the people in Washington need to understand that they do not have, they have access to a printing press, but they don't have access to creating unlimited value. And if you keep printing without producing, all you do is debase your currency, right? And so the answer is, if Washington doesn't figure this out, and they're not going to, the answer is going to be more inflation. Now, I don't like it. I'm not cheering for it. It's horrible. It's wrong. It's going to make life difficult for a lot of people. If you're listening to this, there are things that you can do to protect yourself, right? Stock up on things like food now before prices go up even more. If you have the resources, right? Things like gold, maybe a little bit of silver, Bitcoin, energy stocks, uranium. There are lots of things that you can buy or invest in, assuming you have the liquid funds, but you can switch out of debasing fiat, the dollar, and buy things that are harder to reproduce, that will have more value in the future. So I don't like these government policies. It's not my job to be happy or unhappy. It's my job to help people make money in good and bad environments. So if you know this is coming, and you know more inflation is coming, there are things that you can do to prepare. If you want more help on this, Deep Knowledge Investing does that, right? We help people prepare for this, and we've guided people very successfully through the last few difficult years with a lot of inflation. That's what we're here for. But what's happening with Japan and the yen at 161.5 today, that is a warning that no one in Washington is going to take seriously. But that doesn't mean that we, as investors and citizens and human beings, shouldn't take it seriously and act ourselves.
Thank you for taking my promo opportunity there, Gary.
I'm on it.
What I was going to say is exactly what Gary just said. We've been talking about a lot with inflation, how to position that portfolio, whether good market, bad market, good news, indifferent, whatever it may be. DKI is positioned to help you navigate as these decisions are made, as these situations arise. Be sure to check out plenty of content material on inflation on the blog. And then as well, if you're a premium subscriber, looking at how those current recommendations are positioned for exactly what Gary just mentioned. Moving on to thing number 5. Sorry, I had to check that because I know we had an extra today that I forgot to mention.
We have an extra thing.
Thing number 5, Gary, the jobs data is corrupt. I'm shocked. I added that in there. And then you said, are you surprised? And my answer to that is absolutely not.
Yeah, there is a long-standing deep knowledge investing mantra that if you're looking at government data, you're looking at lies. I'm done pretending that it's a mistake, it's rounding, it's data collection. We're just at open lying at this point. And among the government data, some things are better than others. Like I think the PCE is probably relatively accurate. I think the CPI is probably pretty inaccurate. But the one piece of government data that is horrendous are our jobs data. To give you a sense of how bad the jobs data is, earlier this year, the Philadelphia Fed realized that they had overcounted by 800,000 jobs, almost a million jobs. How is that possible, right? I mean, everything had to be revised. And by the way, the revisions are always in one direction. We always see great employment prints and then quietly later they're revised down. It never goes the other way. Don't tell me it's an accident. I won't believe it. So let's look at California, because that is a unique mess in terms of their reporting. Preliminary reports in California were advertising huge job growth from September to December. So the fourth quarter of 2023 of 117,000 jobs. Now, some people might say, wait, that's not such a huge number, but you're used to seeing national employment data, right? We're usually seeing national employment data in the range of, a couple 100,000 jobs a month. This was California saying we've had growth of 117,000 jobs in a quarter. That's a big number. Then they revised it to a loss of 32,000 jobs. How in the world do you go from saying we gained 117,000 jobs to oops, we lost 32,000? So Andrew's going to throw up the chart. By the way, credit to him. He's the one who did the chart. When you look at this chart, what you're going to see, that blue line shows the growth that was reported, what everybody thought the growth was, and that goes up, and it looks like the employment situation in California is fantastic. The red line, which is labeled early benchmark, shows, oh crap, we've revised it, and that actually has a downward slope. So you go from growing 117,000 jobs to a loss of 32,000 jobs. This is one of the most egregious examples of malfeasance, lying data that I've ever seen. And again, these are numbers that would be bad if they were national numbers, but this is just one state.
Yeah. Being that I am sitting in California, it's by no means a shock that California was so far off. Reminds me of that meme when you look around and everyone else has the answer as 2, yet you have 76 as your answer to the math problem. Gary, I don't understand, and maybe it's not meant to be understood, how and who is getting it this wrong, and what, if any, repercussions are there?
Well, the repercussions are none, right? You can be in government, be incompetent, and never lose your job. Somebody who I've always admired as an economist is Thomas Sowell, who actually, I believe he's in California too. He's at Stanford's Hoover Institute. And one of the things that Sowell talks about a lot is the lack of accountability, that people in government who pursue policies that don't work out well, they don't suffer from it. They don't lose their jobs. They don't resign in shame. They just sort of keep rolling on. At this point, though, given that the data is this bad and this consistently bad, I think we have to draw one of two conclusions. I don't know the answer. You're going to have to figure it out. Either the people doing this are incompetent and not capable of counting the number of jobs, and we either need to report differently or collect the data differently. I don't know. Or alternatively, this is intentional and it's malfeasance, that these people collect the numbers and for political reasons, they want things to look good. And so they report huge job growth, and then later they report the losses, the downward revisions quietly when fewer people are watching. Given that trend, you could draw the conclusion that it's malfeasance. Before I accuse anybody of anything, I'm just going to say I don't know. All I know is the government jobs data is so inaccurate to the point that it is useless. You can't use it to figure out anything about the economy. Whether you think that's due to incompetence, data collection problems, malfeasance, I really don't know the answer, and I'm not accusing anybody of anything specific. But we are now at the point where the data is just useless. The one thing I would say, a couple weeks ago, we complimented Fed Chair Jerome Powell for telling the truth in public. And I'm not being snarky. I really mean it. When asked in his press conference about their projections on the PCE, he acknowledged that they don't have a lot of confidence in their projections. And again, I'm not making fun of him. He told the truth. And I agree with him. I don't have confidence in their projections either. But, remember, this is the kind of data that the Federal Reserve gets, and they have to make their decisions based on this. And with data like this and data of this quality, it's really hard to criticize Chairman Powell for not having confidence in the Fed's projections. And I say that, I've been hard on the Federal Reserve for years. I've been critical of them, but in this case, I think Powell's telling the truth, and I think he's working with really bad data. And if you gave Rob, if you gave me this data, I'd have no confidence in my projections either.
Why even revise the data at this point, right? Like if no one's actually looking, if no one's held accountable, and if you're so far off every single time, yeah, it's just what data do they all of a sudden have to be able to revise down in a completely different direction?
The answer is, if you're off by a couple 100,000 people, a couple 100,000 jobs at a time, 800,000 jobs here, 120,000 jobs in California there, those errors add up over time. And if you start to be off over a few years by 5 million, 10 million, 15 million, at some point, the data becomes so bad that you lose all credibility. What they need to do is they need to keep things reasonably close, where there's some predictability for it. And, I remember this was a discussion I had with my old partner from Silver Arrow, Raji Kabaz, in the early days of COVID. This is in early 2020. The market was trading off of the Chinese reports on their number of cases. And I remember talking to Raji, I said, the data is garbage. The Chinese government is making this up. This isn't even intended to be accurate, but the market was trading off of it. And so, the thing is, you need to be reasonably close. You start to get off by 5, 10 million people, 5, 10 million jobs. Once the data gets so bad, there's a point where China was saying there were like 80,000 cases in Wuhan, and there were credible reports of something like 500,000 cremations, right? And, this was for a disease with a relatively small infection fatality rate. So you knew it wasn't 80,000 cases.
Right.
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 And at that point, nobody believed the data. And so what you don't want to have happen, if you're the government, you can get away with fudging the data. What you can't get away with is having those fudges add up over time to the point where it's just so unbelievable that nobody ever pays attention. At that point, you forget punishment. You have no credibility. You're producing numbers that nobody's willing to look at. And then your lies are useless.
Right. One thing I wanted to note, Gary, when you were talking about Bank of Japan, recording of this, which should be uploaded, today's July 1st. So just something to call out there when you mentioned today.
Right.
You'll see that in the recording as well when we get these uploaded onto YouTube. Moving to the final thing, bonus thing for this week, we're talking about PCE and that reporting, Gary. Thing number 6 to close us out, the PCE declines.
Yeah. So the PCE stands for Personal Consumption Expenditures Index. It's basically an inflation gauge. Now, in the United States, when we talk about inflation, people typically are referring to the CPI. That's the Consumer Price Index. So when people say inflation is 3.5%, they usually mean the CPI. The reason the PCE matters is it more closely tracks actual expenditures. And as a result of that, it's the preferred inflation index of the Federal Reserve. So while most of the press will focus their attention on the CPI, the Federal Reserve is tracking the PCE more closely, the Personal Consumption Expenditures Index. The May PCE came in at 2.6% versus last month and flat versus the month before. So, sorry, I said that wrong. 2.6% versus last year and flat versus the month before. So what they're aiming for is 2%, and they went from 2.7 down to 2.6. That's the direction they were hoping for. No increase in prices from April to May. So they got that flat. The core PCE, that number excludes food and energy and tends to be a little more stable and a little harder to move. That was also down to 2.6, came down from last month's 2.8% and was up only a little bit from month to month. And so the doves are the people who prefer a lower federal funds rate. they looked at that and said, hey, inflation is getting under control. This is a positive here. The hawks who prefer higher interest rates are pointing out, okay, great. We agree it's gotten better, but we're still well above the 2% target. And so, all things being equal, this makes it more likely that the Fed will reduce rates sooner. Sorry, not soon, sooner. It was a dovish report. That said, I still think Powell is going to be watching what happened in Canada, and I would not expect the Fed to lower rates at the next meeting. If you're hoping for lower rates, this PCE report was a positive for you, but don't hold your breath for any kind of movement at the next meeting.
Great stuff, Gary. Don't have a follow up to that. I think you covered all of that pretty well, and pretty straightforward with the PCE. We'll obviously be keeping in tune on new reports and what that means. And Gary, what you believe will happen with the Fed, but higher for longer for now. And we'll continue with that mantra. That concludes this week's 5 things, or in this case, 6 things this week, 1 bonus. Want to wish everybody 4th of July is coming up this Thursday. Stay safe. Have a great time with family and friends while out there. And again, as always, thank you so much for supporting us at Deep Knowledge Investing. We really appreciate you tuning in, engaging with Gary's content, being a subscriber to the Deep Knowledge Investing platform. We're excited to bring more and more of this type of commentary, recommendations, and really just keeping you all in tune with this market and the craziness that we're going to see over the next 5 months. The debate we had last week, and they said, yeah, now just a short 5 months until the election. I'm thinking, my goodness, we got 5 more months of this stuff, but it's going to be a wild ride. And Gary, thank you again for all you do. Any closing thoughts from you?
Thanks, Rob. For everyone watching this again, I know I say this every week, but thanks so much for watching. We know your time is valuable. We appreciate you spending it with us and learning with us. Great to have you here. Last thing, want to wish everyone a really happy Independence Day. It's an important holiday, and never forget the value of independence, of your freedom. Terrific that we're going to have wonderful cookouts and beach days and hopefully good weather for everyone and a chance to get together with friends and family. I just take a minute to think about the value of your freedom, of independence. It's important, and just take a moment for appreciation for that. It's a great holiday for all of us. Wishing everybody a happy 4th of July, happy Independence Day, and we will see you next week.